So this is a video I've been wanting to make for a while. Definitely a work in progress as I wrap my head around the options wheel and some of the statistics and potential returns in the strategy. So I've been trading the options wheel for about 2 months now on anywhere between 7 and 10 underlying stocks. In total, I've sold 104 options and only had 7 assignments, which implies a probability of assignment of only 6.7%. Of those 7 assignments, 2 were assigned calls. You can't lose money on assigned calls, but you do lose paper profits. So I only had 5 opportunities over 2 months across many underlines to lose money. I think that's not bad. To be fair, I'm mainly invested in energy and industrial type stocks, value stocks, and these have done very well in the last 2 months relative to tech stocks in the greater S&P. I sell weekly 30 delta options, and rather than allowing the short options to just expire, worthless hopefully, I actually buy them back when they decline by 2/3 in value. So for example, if I sell a cash secured put for $1, then I would buy it back when its value declines to 33 cents. And I would turn around and sell another option. I simply set a limit order at the same time as I sell the option to achieve this. So sometimes you can get a pop up in the stock price and that limit order will automatically hit. And by the time the stock comes down again, you can sell a put at roughly the same strike for a nice premium. 30 delta options supposedly have a 30% probability of expiring in the money. Even though I'm selling 30 delta options, less than 7% of my short options are getting assigned. So this is great news for me. I like to buy back options and re-enter the trade because it gives me more occurrences. If I was selling monthly options and not buying them back, I would only have a total of 20 occurrences over 2 months. But by trading weekly options and buying them back, I have over 100 occurrences. So I'm getting a richer set of statistical data. In the next example, I'll show you how you can also greatly improve your weekly returns by buying back options and selling a new put with the same expiration. So here's an example for enterprise products, or EPD. In a typical week, I will get a 21% premium from selling a put, and then I buy back that put for 7 cents, which nets me 14 cents, or about 0.6%. For the January 21st weekly options though, the stock price was rising quickly that week. So I bought back the put on January 19th and sold another put with the same expiration at a 50-cent higher strike price. So in this week, I collected a total of 38 cents in premium and spent 12 cents to buy back the puts. So I netted 26 cents, or about 1.2% weekly return. So I pretty much doubled my typical weekly return just by buying back the first put and then selling another one. So this is one of those kind of viewpoints. It's hard to justify. You have to have a long history of back tests, and it's hard to back test with options trading. Really hard. I don't have a rich historical set of options data either, so I can't do it. So it kind of boils down to opinion. I think I've got a justifiable viewpoint for doing what I'm doing, which is, selling options and buying them back and reselling them quickly. Statistically, it gives me more occurrences. That's hard. It's hard to say that that's not worthwhile, but I definitely would love to hear your opinions. And if you think I'm off base or could do it differently, put it in the comments. Let's have a discussion. Let's maybe learn together. So see you next time.